Hello everyone, I am Deepika, 4th semester MBA from SVCE College. I am here to present my topic Master Limited Partnership under the guidance of Sudha Ma'am, Department of MBA SVCE. Master Limited Partnership MLP. MLPs have been popular in the petroleum industry. Oil companies have distributed oil and gas assets to MLPs, allowing the returns to flow through directly to stakeholders without double taxation. Initially, startup businesses may be also structured as MLPs. The MLP may be run by a general partner who receives an income from managing the business. The general partner may or may not own a unit in the MLP. Capital is raised through an initial sale of MLP units to investors. Characteristics of MLPs. MLPs are not ordinary limited partnership. Many limited partnership crashed in the 1980s because they were often not good businesses to begin with and units were very hard to sell, but MLPs trade like stocks often on the New York Stock Exchange and most MLPs are solid businesses. The corporate structure of MLPs and garden variety MLPs, however, is similar. Both give more power to the general partners than most corporations give to management. Each MLP is different. Unlike timberlands, most MLPs do not become nearly worthless after a fixed period of time. But MLPs do have more individual quirks than corporations, so it is best to read the fine print in the natural annual report before investing. MLPs provides tax immunity. Most corporations have an effective tax rate of about 30%. Then shareholders are also taxed on any dividends they receive from the company. MLPs are immune from most taxes because profits flow directly to unit holders. Tax write-offs such as depreciation also go to unit holders, allowing differing some or all of the taxes on distributions until units are sold. Distributions are not dividends. Just as MLP, investors own units, not shares. They receive distributions, not dividends. Distributions are usually part or all of the MLP's cash flow, its earning, profits, depreciation, while dividends are allocated from a company's profits. Types of MLPs. Roll up MLPs. These are formed by the combination of two or more partnerships into one publicly traded partnership. Liquidation MLPs. These are formed by a complete liquidation of a corporation into an MLP. Acquisition MLPs. These are formed by an offering of MLP interest to the public with the proceeds used to purchase assets. Rollout MLPs. These are formed by contribution of operating assets in exchange for general and a corporation's limited partnership interest in the MLP, followed by a public offering of limited partnership interest by the corporation of the MLP or both. Startup partnership. Startup MLP. A fifth category of MLP that may be well predominate in the future is the startup MLP, formed by a partnership that is initially privately held but later offers its interest to the public in order to finance internal growth. Advantages of MLP. Predictable cash flows, distributions taxed only once, huge yields, less volatility than regular energy stocks, enormous potential for price appreciation. Disadvantages of MLPs. Investors have little voice in company decisions. General partners, limited partners. Limited partners receive less when distributions are raised. Partnerships bring greater liability. Tax issues are potentially complex. Thank you.